in uncharted territory here on so many different fronts. I mean, the scale of the economic dislocation, and as I've said to some of my recent reports, I do fear that in fact the financial markets, particularly the equity markets, may well have got ahead of themselves, and I'm now turning very, very cautious yet again on particularly on the U.S. equity markets in the next few weeks and months.
Surely enough. I just want to bring in one more concept which the RBNZ has flagged, Jonathan, and that's inflation index bonds. In that struggle and all that talk about deflation, that being debated against whether all this easy money will actually turn out to be inflationary for economies somewhere down the road, it is important to give corporates, companies out there, some measure to de-risk the risk that comes in or the risk that is associated with varying inflation prints. Do you think that's going to be also something to watch out for, a trend making?
Well, I think the overwhelming trend here in the near term, Tanvir, is deflationary. Obviously, when you get this collapse in demand, as we've seen right across the world, I mean, that has a very, very notable deflationary impulse. So over the next 3 to 6 months and perhaps even longer, we're going to see disinflationary trends. Here and now, we have depressionary type economic conditions. Therefore, that will lower consumer price inflation pretty much everywhere. But down the road, of course, we could get some inflationary increases. But right now, I think we need to focus on the negative shocks, the negative impact of this extraordinary deterioration in economic activity. And that is one of the reasons why I think now the U.S. market and equity markets generally have run ahead of themselves. Because if we look at valuations, particularly in the United States, they're now at extremely high levels, which I think is anticipating too much of a positive V-shaped type recovery. And I would exercise extraordinary caution at this moment in time in terms of equity markets.